Hello, good evening, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to the initiative of Fundamentals of Indian Economy. Today is the third session, and in this session, we will have a detailed discussion regarding the important tools under the concept of monetary policy. And in the course of the discussion, we will also solve certain practice question. And at the end of the session, I will have a discussion regarding certain PYQs which have been asked in the last couple of years on the concept of monetary policy. Before I start, as usual, some of you will keep on commenting and asking me, Sir, where do I download the PPT's PDF? All you need to do is simply join the Telegram channel, the QR code for which is displayed here. After the session is over, the PPT as well as the handout will be made available in the Telegram channel. Second, I know a lot of you are preparing for the Civil Services 26 and 27. Lot of you confused regarding what strategy you must follow. Lot of you confused regarding subjects such as polity and Indian economy, the book list, how to make notes, current affairs, etc. To address all of your doubts, on the 5th and the 6th, we have arranged Unacademy's UPSC Summit. On these 2 days, various experts from the field of civil services, from the field of sports, etc., will be taking sessions. Educators will be taking session. In fact, my session is also there where I'll be discussing how do you prepare for the civil services Indian economy specific civil services exam that will be taken on 6th, that is evening 6th, that is Sunday, 6th July 2025. Please do attend these sessions. To attend the session, all you need to do is register, the link for which is provided in the description below. Done? So let me start the discussion now. So today I'll be discussing the concept of monetary policy. Right now, listen to me very carefully. In the area of, let's say, the Indian economy, under the subject of Indian economy, there are two very important policies that you are expected to read. One is the concept of monetary policy. I'll tell you the meaning of it in a minute. Second one is the concept of fiscal policy. Monetary policy basically refers to the tools which are used to adjust the money supply. The different tools which are used to adjust money supply in the economy. Whether should we increase the money supply, decrease the money supply, we will use a certain tools. All those set of tools collectively are referred to as monetary policy tools. Or else, there is one more name for this, the credit control tools. Credit control tools. Okay, so using the monetary policy, what we will do? We will adjust the money supply in the economy. How? You will understand in this session. Do not worry. Second very important policy I said is the fiscal policy. What is the meaning of the term fiscal policy? The policy used by the government to basically adjust, right, the concept of the expenditure, to take care of the expenditure and taxation. To take care of expenditure and taxation, that will be referred to as fiscal policy. Under fiscal policy, the government will, let's say, incur certain expenditure, will collect taxes. So the policies that are associated with expenditure and taxation are referred to as fiscal policy. So in today's session, I'll cover the monetary policy. Tomorrow's session, I will cover fiscal policy. Very, very important. Those who have seen the prelims paper, very recently conducted the prelims paper, you will know questions have been asked on the monetary policy as well as the fiscal policy. Now, let me start the discussion. Monetary policy, listen to me carefully now. Right now, the monetary policy in India, the policy that we follow is called as bi-monthly monetary policy. Please remember the term bi-monthly monetary policy. What is the meaning of the term bi-monthly monetary policy? The monetary policy will be announced once every 2 months. Once every 2 months, the monetary policy is announced. Don't read it reverse. That is not twice in 1 month. No, it is once every 2 months. And for announcing the monetary policy, the government of India has set up a committee called as Monetary Policy Committee, MPC, Monetary Policy Committee. The Monetary Policy Committee will consist of 6 members. Out of these 6 members, 3 are from Reserve Bank of India, RBI. 3 are from Reserve Bank of India. And the remaining 3 are the experts who are appointed by Government of India. The composition clear to all of you? Please do let me know in the chat section. 3 are from Reserve Bank of India, and the remaining 3 are the experts who are appointed by Government of India. So it is this composition of 6 members or the committee of 6 members who will meet once every 2 months, deliberate, discuss, and take a call regarding the interest rates. I'm writing the term interest rate here. They will also use the term policy rate. Do not be confused. Interest rate or policy rate. What is interest rate or policy rate? Essentially the repo rate. We will understand what is repo, what is the connection of repo with other interest rates, etc. etc. Don't worry. So these are certain introductory points associated with the concept of monetary policy committee. Now, what are the different tools that we will be discussing in today's session? What are the different tools? We'll go one by one after the other. We will discuss all the tools. You please listen to the lecture carefully. There are two sets of tools. One is called as quantitative and the second one is called as qualitative. One is called as quantitative, second one is qualitative. And the other names of quantitative and qualitative is, in case of quantitative, these are called as general monetary policy tools or general credit control tools, and qualitative are referred to as a specific monetary policy tools or specific credit control tools. What is the reason? Why do we call these as general? Why do we call this set as specific? The argument is very simple. Using the first set of tools, first means I'll write the number here. Please have a look at this. Using the first set of tools, we will be able to change the overall money supply that is happening in the economy. Overall money supply. How much money is being supplied in the overall economy, we can reduce it, we can increase it. But when you say specific set of tools or qualitative set of tools, using these tools, RBI can target a specific sector, and in the specific sector, money supply can be increased or decreased. Is everybody able to understand the difference between qualitative and quantitative? Please do let me know in the chat section. Everybody is okay with the difference between qualitative and quantitative. Right now, don't worry. Don't ask me, sir, give me example, how it will change, etc. We will discuss these tools one by one. You will understand it. But the intro is very simple. Qualitative, you will be able to change money supply in specific targeted sectors. Quantitative, overall money supply. In the economy, either the money supply will be increased or decreased. Now let me start. These are the set of tools under the quantitative and these are the set of tools under the qualitative. The most important tool, I repeat, the most important tool out of all of this is the repo rate. Let me start with that only. The most important tool is the repo rate. Now, what is the repo? Before that, solve this question. Right, let's start with one MCQ. Solve this question. Please do let me know what is the right answer before I solve. It's a very easy question. You should be able to solve this very quickly. Which of the following are the tools used by RBI if the aim is to change money supply targeting specific sectors? Cash reserve ratio, variation of margin requirements, repo rate, rationing of credit. And I know I have not discussed the tools as of now, but at least if you have observed these two set of tools, you'll be able to solve it now. Right? That is second one is right a second part of the second set of tools. Fourth one is part of the second set of tools. Cash reserve ratio, overall money supply can be changed. Repo rate, overall money supply will be changed. So 2 and 4, right option will be option A. Right option is option A. Now let me start with qualitative and quantitative. And specifically quantitative, the most important one, repo. The most important one is the repo. Now what do you mean by repo? Very simple technique, very simple definition first, then I'll give you the technical definition. Repo simply stands to represent the interest rate. IR is interest rate, not international relations. Don't simply say, sir, you're writing international relations. Why are you discussing Chetan's subject? You are economics faculty, stick to economics. Agreed. IR is interest rate here. So, the interest rate that RBI will charge, RBI will charge when RBI will provide short-term loans to banks. Is everybody okay with the definition? I'll repeat this again. Right? Repo rate means what? It is the rate of interest that is charged by Reserve Bank of India when it will provide a short-term loans to banks. What do you mean by short term here? Generally, in the context of economy, please remember short means up to 1 year. Generally, until and unless it is specified, short you take it as up to 1 year. Right? More than 1 year, there is a different term for that. Short means up to 1 year. So whenever the loans are provided for short duration, sir, how short? 1 day. It could be 7 days. It could be 14 days. It could be 28 days, etc. So whenever short-term loans are given by RBI to the banks, the rate of interest charged by RBI is called as repo rate. Is everyone okay with a very simple definition of repo rate? Now let me make it a bit more confusing. Listen to me very carefully. There is one tool called as bank rate. Somebody was mentioning regarding marvelous edits, mentioning about bank rate. Listen to me carefully. There is one more tool called as bank rate. What is bank rate? It is also the interest rate that is charged by Reserve Bank of India when it will provide loans to banks. It is also the interest rate that is charged by RBI when it will provide loans to banks. But now many of you will be confused. You'll simply say, sir, repo is also rate of interest. RBI will give a loan, charge it. Bank rate is also rate of interest. RBI will give loan, charge it. What is the difference? What is the difference between a repo and a bank rate? Are they both one and the same? Absolutely no. Listen to me carefully. Bank rate is purely a lending rate. I repeat, bank rate is purely a lending rate. Meaning what? Loan is given, RBI will charge rate of interest. Whereas a repo simply stands for a term called as repurchasing order. Repurchasing order. Now you will simply say, sir, what is repurchasing order? What do you mean by this? Repurchasing order simply means there are two sides. I'm using the term two sides. You can use the term two parties as well. There are two parties where one party will sell an asset to another party with the promise of repurchasing the asset after specific number of days at a specific price. I'll repeat the concept here. All of you, please listen to me. What is repurchasing order? It is essentially an agreement between two parties where A will sell an asset to B today, but with the promise, with an agreement saying that I will repurchase the asset after specific number of days and at specific price. That is called as repurchasing order. Is everyone okay with the concept of repurchasing order? Please do let me know. Is everyone okay with the concept of repurchasing order? Do let me know in the chat section. Now, what actually happens under repo rate? Simple. Here is Reserve Bank of India and here is bank. Okay. Step 1. What happens in the step 1? The bank will sell government securities to RBI, bonds to Reserve Bank of India, let's say worth 100 rupee, and RBI will give 100 rupees to the bank. Step 1. Step 2, let's say after 7 days. After 7 days. After 7 days, what will happen? RBI will return the government security to the bank, will return the asset to the bank, and in return will get 110 rupees from the bank. 110 rupees. Now, can I simply say, here is two parties where one party is selling an asset to another party with a promise of purchasing back the asset after 7 days at 110 rupees. What will be the interest rate? Can I calculate the interest rate? 10 rupee, 110, 100 is the initial amount, 110 is the final amount. 10 rupee upon the investment of 100, upon the value of 100. Can I simply say interest rate or the rate of interest in the calculation will be 10%. That is nothing but, my dear, repo rate. Is everybody okay with the concept of repo rate? Please do let me know. Is everyone okay with the concept of repo rate? Now tell me, if somebody will ask you, is the repo rate same as the bank rate? Will there be anybody in the session who will say both are one and the same? Or is there anyone still in the session who will simply say, sir, both are confusing. Both look one and the same to me. Both are purely lending rates. Absolutely no. Repo is a contract. Repo is an agreement where RBI will first purchase the asset and sell it back to the bank at a higher amount. Whereas a bank rate is purely a lending rate. RBI will give a loan and charge a rate of interest. So please be very careful. Both are slightly confusing to you because this concept is not generally provided in the books. It is not generally provided. If you go through the books, they'll simply say repo rate is the rate of interest charged on short-term loans. They'll say bank rate is rate of interest charged on loans. But if both are rate of interest, what is the difference? Is everybody okay? Now this is one repo. This is second bank rate. Now let me go forward. Third one, there is a concept of CRR. I'm using the short term CRR. Right? What is CRR? Cash reserve ratio. I'll start using the short forms. Please don't get confused. CRR, cash reserve ratio. SLR, statutory liquidity ratio. OMO means open marketing operations. Okay, now let's start. What is CRR? Now, to explain the concept of CRR and SLR, let me give you one more concept. That is, for a bank, there is a certain amount which is calculated as assets, and there is certain amount which is calculated as liability. Right? What is the meaning of it? Imagine you keep 100 rupees in the form of a deposit with a bank. Now, can I simply say this 100 rupee for you as a depositor is an asset? But for a bank which has to return this 100 along with the interest to you, for a bank it is a liability. Everybody is okay with this? For you it is an asset. For a depositor, the deposit is an asset. But for a bank, it's a liability. But on the other hand, imagine you take a loan of 100 rupee from a bank. You are taking a loan of 100 rupee from a bank. That 100 rupee is a liability for you because you will have to return it. Whereas that 100 rupee for a bank will be an asset. Why? Along with giving back 100 rupee, you will pay interest to the bank. So the deposits are liabilities for the bank, whereas the loans are assets for the bank. This is point number one. And within the concept of deposits, there are two types of deposits. One, we'll call this as a time deposit. Second one, we will refer to this as, right, the demand deposit. One is a time deposit. Second one is demand deposit. What is a time deposit? You will keep FD with the bank for 3 years. Can I now simply say for 3 years, that is a time period, the amount will be kept with the bank? Right? That is a time deposit. What about your savings bank account, your salary accounts, etc.? You can withdraw the money from these accounts whenever you want to. Whenever you have demand, right, the bank will allow you to withdraw money from the savings account. That is, my dear, the demand deposits. Everybody is okay? Demand deposits and time deposits. Now, all of these are nothing but liabilities, and the technical term used, remember the technical term, net demand and time liability. Net demand and time liabilities. In short, NDTL. In short, NDTL, net demand and time liabilities. Everybody is okay with NDTL? Now let me use this concept to explain to you the cash reserve ratio, and the fourth one here itself, the statutory liquidity ratio, CRR as well as SLR. Let's start. What is CRR? It is the percentage of NDTL. It is the percentage of NDTL that the bank will have to keep with Reserve Bank of India. Is it okay? I'll repeat this again. It is the percentage of NDTL that the bank will have to keep with Reserve Bank of India. That is, imagine, just for sake of understanding, imagine you have collected 100 crore deposits. Right now, let's say CRR, let's say hypothetically is 4%, although it has been reduced very recently. Let's say hypothetically 4%. What does it mean? It simply means out of 100 crore, you'll have to take 4 crore rupees, deposit this 4 crores with Reserve Bank of India. And on this, please remember, RBI doesn't pay interest. RBI doesn't pay any interest on this. Everybody is okay? Historically, if you see, historically, what is the limit generally fixed for CRR? RBI generally fixes the CRR in the range of 3% to 15%. RBI generally fixes the CRR in the range of 3% to 15%. Again, is it mandatory right now? No, but generally this is the range. For example, very recently, RBI has announced that it will be reducing the CRR by 100 basis points, that is from 4% to 3%. Everybody is okay with the CRR now? Do let me know. Everybody is okay with the cash reserve ratio? What about SLR? Statutory liquidity ratio. It is the percentage of NDTL. Percentage of NDTL that the banks will keep with themselves. That the banks will keep with themselves. Not with RBI, but with themselves. Generally, the options that are given to the banks are simple. The banks can keep the SLR in the form of gold. You're allowed to keep the SLR in the form of a gold, or you can keep it in the form of a cash, or you can keep it in the form of approved securities. You can keep it in the form of approved securities. For example, the government bonds, central government bonds, state government bonds, sovereign gold bonds, etc. Right? So certain securities are allowed. You can take this amount, invest and purchase these particular securities. How it will happen in reality? Let me give you the same example. Imagine your NDTL is 100 crore rupees, and let's say SLR is, right, let's say hypothetically 18%. Again, just hypothetical numbers here. SLR is 18%. What does it mean? Out of 100 crore, now you'll have to keep 18 CR with yourself, either in the form of cash, or in the form of gold, or in the form of approved security. Now, before I go forward, one more very important point here. Although under SLR, multiple options are there. Although under SLR, multiple options are there with with the banking sector, the banks generally choose to invest in government security. I'll repeat the statement. Although multiple options are there, they can keep it in the form of a cash, they can keep it in the form of gold. The banks generally prefer to keep the SLR in the form of government securities. Why? What is the reason? Is there any logic behind this? The government securities are one of the safest investments in the market. Remember this. The government securities are one of the safest investments in the market. For example, if you invest in the invest instruments issued by the central government, These are called as government bonds. If you invest in, let's say, the central government bond, these are very, very safe instruments. Right? In history of India, post independence, there is no instance where government of India has taken the loan and has defaulted. Defaulted means it has not repaid. There is no instance in the post independence history that government of India has defaulted on the payment. Government of India always has paid the payment. Always has done the payment. That is the precise reason, because the instruments are very safe. Very, very safe. Lowest risk in the market. The banks generally prefer to invest in government bonds. Chirag is asking, why not in gold? My dear, the gold prices are very volatile. The gold prices are very volatile. Today the price is 1 lakh rupees per 10 gram. Tomorrow it can become 95,000 also. Correct? Possibility is always there. Day after tomorrow it can become 90,000 also. It can also become 1 lakh 20,000 also. I hope you understand. Volatility is very high. Uncertainty is very high. You think as a banker, you think the banks which are using customers' money will be comfortable with that kind of a volatility in their investments? Just think of it. You think the banks are happy with that kind of volatility in their investments? Banks are generally never happy with that. Investor also never is never happy with that kind of volatility. Is everybody okay with these particular tools? Do let me know. Is everyone okay with these particular tools? So what are the tools that I've discussed so far? Cash reserve ratio, done. The bank rate, done. The statutory liquidity ratio, yes. Right. The repo, yes. Reverse repo, I've not yet discussed. I'll discuss now. Standing deposit facility, I'll discuss. OMO, I'll discuss. Okay, now let me start. What is this concept of OMO? Let me start with OMO now. Open market operation. Open market operation. What is the meaning of open market operation? Under open market operation, essentially it means the Reserve Bank of India, the Reserve Bank of India will be either purchasing or selling government securities in the market. I'll repeat the statement. Listen to me carefully. What is OMO, open market operation? It is essentially an operation. Operation means activity which is conducted by Reserve Bank of India, under which RBI will be either buying the government securities or selling the government securities in the market. Buy or sell. That is called as open market operation. Some of you will be thinking, sir, what is the logic? Why will RBI buy the government securities? Or why will RBI sell the government securities? Is there any logic behind it? The logic is simple. Whenever RBI wants to promote growth, whenever RBI wants to promote growth, can I simply say RBI has to reduce interest rates in the market? Do let me know. Yesterday we had a discussion regarding this as well. If RBI wants to promote growth, interest rates in the market should be lesser. Correct? Everybody will accept this. Now, one way to reduce interest rate is increase money supply. Is simply increase money supply. Increase the money supply in the market. When there is very high amount of money supply, automatically interest rate will go down. Some of you will be confused. Some of the people, some of the students will simply say, sir, it is not making sense to me. Let me explain that with a very simple example. Imagine you have 100 rupees. I want to take a loan from you. And if you are the only person in the market with 100 rupees, don't you think I will have to pay the rate of interest that you will demand? Correct? You will basically demand 10%. I don't have any option. Nobody else is there in the market to give me a loan of 100. I will agree to you. But now imagine, along with you, there are 5 more people with 100 rupees who want to give loan. Now you tell me, will you demand a rate of interest and will I accept it? Or I will determine the rate of interest now. If you simply say 10%, I'll simply say, not possible. Look at your neighbor. The neighbor also has 100 rupee. They are willing to give me 9%. That is the rate of interest they are willing to give me at 9%. Or I'll simply say, look at the third person. He or she also have 100 rupee. They will give me this 100 rupee at 7% rate of interest. So everybody is able to understand the logic behind it. Do let me know in the chat section. Everybody is able to understand the logic behind it. When you increase the money supply, interest rates will automatically go down. And how can RBI do that? RBI will start purchasing the instruments from the banks. They'll start purchasing the government bonds. From individuals such as you and me, we are also allowed to purchase government bonds. RBI will purchase government bonds. So now you tell me, if RBI will start purchasing government bonds, don't you think money supply in the market will increase? And when the money supply increases, what do you think will happen to interest rates? Interest rates automatically will go down. And when interest rates will go down, can I simply say more borrowers will take loans now? More companies will take loans. They will invest. They will create employment. More right wages will be paid. More salaries will be paid. More production will happen, etc. That will be done essentially to promote growth. Everybody is okay with the argument here. So whenever RBI wants to promote growth, RBI one way will promote growth by purchasing government bonds. But understand this, whenever this kind of money supply increases, also danger. I'm coming to that only. Some of you are raising the issue. I'm coming to that only. Whenever money supply is higher in the economy, there is also danger that the money in the market will be too much. There is very high amount of money supply which is there in the market. Don't you think that will eventually, if not controlled, will lead to inflation? Yes or no? We have discussed inflation yesterday. And those who have not attended the session, please do attend. Watch the recorded video. If the money supply becomes too high, is there a danger of contributing to inflation? Of course, yes. There is a danger. So what does RBI do now? RBI has to reduce the money supply. It has to reduce the money supply. And how can RBI reduce money supply? Now, can I simply say RBI is having certain government bonds, government securities. RBI will start selling the government securities. RBI will give the government securities, take away the money from the market. That is essentially reducing the money supply. Is everybody okay with the concept of open market operation? Please do let me know. Is everybody okay with the concept of open market operation? So whenever there is a very high inflation, RBI will sell government securities, take out the money from the supply, reduce money supply. Whenever RBI wants to promote growth, RBI will simply start purchasing government security. So that is essentially the activity which is called as open market operation. Now let me ask you one question. Based on the explanation of repo and open market operation, all of you will be okay if I say repo is a type of open market operation. Let me see how many of you understand, how many of you will be able to connect the dots. Based on the concept that we have discussed of OMO and repo, everybody will be okay if I say repo is a type of open market operation. That is under repo. What is RBI doing? What is RBI doing under repo? Right? Everybody remembers this? RBI is buying the government securities and selling government securities. Is it not a type of open market operation? Of course, yes. Of course, yes. Right? But please understand, repo is done for short duration. Is the term okay with all of you? I've told you this already. Repo is done for what? Short duration. 1 day, 7 days, 28 days, etc. So that is the precise reason. If at all RBI will use repo, please remember the change in the money supply will not be for a longer duration. It will be done for a very short duration. There's a term called as durable liquidity. All of you, please listen to me very carefully. There's a term called as durable liquidity. Right? What do you mean by durable liquidity? The money will be there in the market for very long duration, for 1 year, for 2 years, for 3 years, etc. But you tell me, under repo, do you think the money that will change, the supply of money that will change is durable liquidity? Don't you think, if you remember the repo, I'm going back to the repo system here. Please have a look at this. If the step 1 and step 2 are done after 7 days, think of this. Step 1 is done today, RBI will give 100 rupee to bank. After 7 days, the bank will return 100 rupee plus 10 rupee to RBI. So don't you think the 100 rupee that increased, the money supply that increased by 100 rupees today, after 1 week, will again go down by 100 rupee. So everybody is able to understand, repo or reverse repo for that matter will change the money supply, but it is not durable. It is not at all durable in nature. Then is there anything that is going to change the money supply for durable nature? That is for longer duration. For example, now tell me, what if RBI reduces CRR, which has been done by RBI very recently, by the way. Now tell me, what if RBI reduces CRR? Will this change the money supply? Will this change in the money supply be durable in nature? Everybody is able to understand the difference here. These are the conceptual things that you need to understand. Do let me know right now. If RBI reduces CRR and RBI doesn't keep on changing CRR very often, I hope you understand. Somebody will say, sir, how can you call this as durable? If RBI has changed CRR today, it will again change the CRR, increase CRR maybe after 1 year, maybe after 6 months, or maybe after 2 years, maybe after 3 years. That's the reason if the CRR is reduced, it will lead to a change in the durable liquidity in the market. SLR, it will lead to change in the durable liquidity in the market. Repo, no. It doesn't change the liquidity for a longer duration. It is for a shorter duration. Done? Now, what is the concept of a reverse repo? Let me explain the reverse repo here. What is the concept of reverse repo? Now, all of you remember repo? Simple. All of you remember repo? What will happen in the step 1? In the step 1 of repo, here is RBI. RBI will purchase the government security and pay 100 rupee to a bank. Now reverse it. Simple. Reverse it. What do you mean by reversing? Under reverse repo, I'll write it here. Step 1, here is the Reserve Bank of India. RBI will sell the government security to the bank and collect 100 rupee from the bank. Everybody is okay. And again, this is for short duration. Maybe for 1 day, maybe for 7 days, maybe for 28 days. Let's say after 7 days. After 7 days, let's say step 2. RBI will get the government security back, will repurchase the government security from the bank and will return, let's say 105 rupees for the bank. Right? So again, the concept is simple here. It is done for shorter duration. It is done for shorter duration, exactly opposite to repo. Exactly opposite to repo. Is everybody okay with the concept of repo, reverse repo, and the open market operation? Please do let me know right now in the chat section. Somebody is asking repeatedly regarding the repurchasing order. I'll give you the example. I'll explain that again at the end of the session. Have patience. But understand this problem now. Whenever you're looking at reverse repo, there is one problem faced by RBI. There is one concern. What is the concern? What if in the step 1, please listen to me carefully. What if in the step 1, the bank will bring, let's say, 500 rupees worth of government securities? Think of this. In the step 1, right, the bank will bring 500 rupees, not worth the government security, 500 rupees. They want to keep this 500 rupees with RBI, but the RBI doesn't have 500 rupees worth of government security. What if RBI has only 300 rupees worth of government security? What if RBI has only 200 rupees worth of government security? Don't you think lesser value of government securities, if they are there with RBI, reverse repo will fail in that situation? Please do let me know in the chat section. If the banks want to keep, let's say, 500 rupees with RBI under step 1 of reverse repo, RBI doesn't have 500 rupee worth of government security. Don't you think reverse repo will fail there? Right? That will not be operable because the RBI doesn't have sufficient value of government securities. Is there a probability? Yes. Is there a probability? Yes, probability is there. It has not happened, but the probability is. And that is the precise reason. Instead of reverse repo, now there is one more tool. Instead of reverse repo, there is one more tool, and that is called as standing deposit facility. Please remember this. Standing deposit facility. SDF. Standing deposit facility. What happens under the standing deposit facility? Listen to me. It is purely a lending rate. It is not connected to repurchasing order. It is not the concept of a reverse repo. Absolutely no. It is purely the concept of a lending rate of interest. That is, here is the Reserve Bank of India. I'll write it at the top of the slide on the left side. Please have a look at this. Here is the Reserve Bank of India. Here is a bank. The bank will deposit money. That's it. The bank will deposit money. That is, give money to RBI, and RBI will pay rate of interest to the bank. Now tell me, in this particular concept of a standing deposit facility, is there any requirement of a government security? Do let me know. Is there any requirement of a government security? Even if government securities are not there with RBI, doesn't matter. Under STF, right, basically the banks will deposit money with RBI, RBI will pay rate of interest. No requirement of collateral whatsoever. Collateral is nothing but security, that is government bonds. Is everybody okay with the concept here? Please do let me know. Everybody is okay with the concept? Now, what is important? Questions are being asked on the concepts. Right? Does SDF require any kind of collateral? No, it is purely a lending rate. Bank rate, does it require any kind of collateral? No, it is purely a lending rate. Repo rate, does it require collateral? Yes. Reverse repo rate, does it require collateral? Yes. Now, apart from this, always remember this. Repo and reverse repo are available only when RBI announces it. I'll repeat the statement here. Repo and reverse repo are available only when RBI announces it. That is, RBI will simply say, for the next, right, let's say 15 days, repo is available. For the next 28 days, reverse repo is available. So, RBI has to announce only and only then this facility is made available. Whereas the concept of STF, remember the key term here, the term is standing. Right? Remember the key term, standing. Whenever you come across the term standing in the context of RBI tools, standing means it is available throughout the year. I'll give you one more example, but please right, remember this. Standing means it is available throughout the year. It is available throughout the year. Right? That is, it is not announced by RBI. If it is a working day, you can use the facility. Is everybody okay? And as expected, many of you are asking, is bank rate and STF same? My dear, you tell me. Right? It should not be a confusion now, but is STF and bank rate one and the same? Are you not following the discussion? It hardly been 45 minutes. Please have a look at the bank rate. What is happening in the bank rate? You tell me now. What is happening in the bank rate? In the bank rate, RBI is lending to a bank charging a rate of interest. What is happening in STF? The banks are lending to RBI charging a rate of interest. So, I hope you understand. It should not be confusing. Bank rate is essentially RBI to bank. STF is bank to RBI. Bank to RBI. Everybody is okay with this? Please do let me know. Everybody is okay? So these are the different types of tools. Repo, reverse repo, standing deposit facility, bank rate, cash reserve ratio, statutory liquidity ratio, open market operations. Done? Now, if you want to understand why repo rate is so important, next important point. If you want to understand why repo rate is so important, why repo rate is called as the policy rate. All these rates, that is, be it bank rate, be it bank rate, be it, right, let's say the reverse repo rate, be reverse repo rate, or be it standing deposit facility. There is one more tool. I'll explain this. Just give me a minute. Marginal standing facility, MSF. Marginal standing facility. All of these are connected to repo rate. Is everybody okay with this statement? I'll give you a number. Don't worry. I'll explain that with a number. All of these are connected to repo rate. What do you mean by this? If repo rate will change, automatically all of these will change. I'll repeat the statement here. If repo rate will change, all of these MSF automatically will change. Bank rate automatically will change. STF automatically will change. And reverse repo rate will automatically change. And how they are connected in sequence? Remember this. The highest, I'll write it here. The highest is generally the bank rate and the marginal standing facility. Below that, it is the repo rate. Below that, it is the standing deposit facility. And below that, it is the reverse repo rate. And how the connection is established? Simple. RBI will basically establish this relationship and say repo rate plus, let's say, half percentage. Half percentage is equal to MSF or bank rate. Repo rate minus half percentage, they'll simply say it is the standing deposit facility. Now tell me, all of you, I want answer from all of you. You tell me. If repo rate will change, all of you will agree, MSF automatically will change. If repo rate will change, don't you think automatically, right, STF will change? If repo rate will change, again there is a formula. That is, the certain percentage is already fixed. Don't you think automatically the reverse repo rate will change? If repo rate will change, automatically the bank rate will also change. And that is the precise reason, right? And now it is your turn to observe things. Please observe the things. Whenever you read the newspaper, they will only talk about policy interest rate. Whenever monetary policy announcement will happen, most of the times they will only talk about policy interest rate. They'll not keep on saying repo rate is changing as a result of this, the bank rate will change. As a result of this, STF will change. No, absolutely no. They will not announce all of it. They will simply make a change to repo. Automatically, other rates will get adjusted. Everybody's okay? Now, there is one more tool I made to discuss, MSF, Marginal Standing Facility. Now, imagine you are a bank. Right? Listen to me carefully. Imagine you are a bank. Now, there is some emergency. You want money. I repeat, you are a bank. There is some emergency. Sir, what kind of emergency? Let's say long weekend is there. Festival season is there. People are withdrawing money for expenditure purposes. People are withdrawing money to pay income taxes, etc. Companies are withdrawing money to pay corporate taxes, etc. So imagine there is a time when you need money urgently, only for, let's say, one day. Tomorrow morning you will get the money, again people will come and deposit. Only for one day you want to borrow money. There is a facility available from Reserve Bank of India which is called as Marginal Standing Facility. Look at the name, Marginal Standing Facility. What is the meaning of it? Under this tool, you can borrow from Reserve Bank of India throughout the year. Short term, but this facility is available to you throughout the year. Unlike, let's say, repo, reverse repo, where the announcement has to be done, Here, there is no requirement of announcement. It is already there. You want money in case of emergency, go to RBI, borrow. Again, G securities will have to provide, borrow, pay rate of interest. That is the concept of marginal standing facility. Is everybody okay with all the tools under the quantitative now? I'll shift to qualitative. Do let me know. Is everybody okay with all the tools under quantitative? And more importantly, now you people answer to my question. Whatever tools we have discussed so far, using the tools, can I simply say the overall money supply in the economy will change? Either money supply will increase or money supply will decrease. Overall. So far, none of these particular tools I've used it to change money supply in agriculture sector. No, not possible. Using the quantitative, not possible. I've not used the tools to change money supply for gold loans. Not possible. Overall in the economy, money supply can be increased or decreased. Now come to qualitative. Shift to the qualitative set of tools. The most important qualitative set of tool is a rationing of credit. Here itself you will understand why this is called as qualitative. But before that, before I explain to you the concept of rationing, let's solve a question. Let's solve an MCQ. Please do let me know what is the right answer to this question before I solve it. Which of the following are used to increase durable liquidity? Which of the following are used to increase durable liquidity? Increase the repo rate. Whether increase or decrease, it doesn't matter. You tell me. Can the repo rate be used to change a durable liquidity? No, short term. Increase or decrease doesn't matter. Don't waste your time. Repo can only change short term liquidity, not durable liquidity. Incorrect. Although you can use elimination method, don't worry. Reduce SLR. Yes. If you reduce SLR, now the banks will have more amount of money to lend in the market. Yes. Increase the CRR. If you increase the CRR, durable liquidity will go down, not right. So third one. So second one is correct. Right option is option B. Option B is the right one. Some of you are saying three. Yellamma Gaudara. Gaudara, please right, correct yourself. It's not three. Third one is incorrect. Or for that option C is incorrect. Okay. Okay, let me continue now. The concept of rationing of credit. Right? That is basically by explaining this, I will make you understand why this is a concept of qualitative tool or specific credit control tool. Point number one, what do you mean by rationing? Rationing simply means distribution. All of you, please remember this. What do you mean by rationing? Rationing means distribution. Now, whenever there is a particular bank, if they want to give loans, they always prefer to give loans to, let's say, rich people. They prefer to give loans to companies. They prefer to give loans, right, let's say, to businessmen, etc. Right? Why? Their argument will be rich people or businessmen or companies, right, generally repay the loans. And it is safer for them, more safer for them to give a loan to a businessman rather than giving loan to, let's say, a farmer. Because just think of it, farmer, when they will, right, let's say, invest and cultivate, there is no guarantee. How much money they will be able to earn? There is no guarantee. How much will be the production? Guarantee. Right? Will all the food grains that are produced by the time when they reach the market, are the prices stable, prices higher? No guarantee. The argument in the banking sector is simple. Rather than giving loan to risky borrowers where there is potential of losses, let's give loan to safer borrowers. That is rich people, high net worth individual, the companies, the firms, etc. But as the Reserve Bank of India, will you allow this to happen? Think of it. Right? 855, congrats your RBI governor. Will you be happy with this kind of a practice of the banking sector? You will never be happy. So what RBI has done, They've introduced the concept of rationing of credit. And it's been multiple decades since the introduction of rationing. What is done under rationing? There is a tool by the name of priority sector lending, PSL, priority sector lending. What is done under priority sector lending? RBI simply says for most of the banks, I'll give you exceptions, but listen to me. For most of the banks, 40% of the loans that you provide in 1 year will have to go to specific sectors. Is the statement okay with all of you? Please do let me know. 40% of the loans that you provide, although technical term is A and B C, don't worry. 40% of the credit, that is loans, it has to go to specific sectors. What are the sectors? Totally 8 areas. 8 areas are there. I'll give you some examples. Agriculture. Agriculture is one of it. The micro, small, medium enterprises is another one. Education, it is another. Weaker sections of the society, another one. Housing, etc. Right? Multiple types are there, totally 8. I've given you 5 examples. Don't worry. Listen to me now. Now you tell me, if RBI mandates that under the PSL, 18% of the loans, 40% is for all the 8 sectors. But RBI simply says under PSL, 18% of the loans will have to go to agriculture sector. You tell me, if this will be changed from 18 to let's say 22%, will there be increased money supply in specific one sector? If RBI will change this from 18% to let's say 15%, will there be a change in the money supply in specific targeted sector? All of you able to understand this? So now tell me, using this tool, can RBI target a sector and change money supply only in that sector? Can they target specific sectors? Yes. That's the reason these are referred to as qualitative set of tools or specific credit control tools. Multiples are there. Other tools are also there. We will discuss it. But with the first example itself, all of you are able to understand the difference between quantitative and qualitative. In quantitative, overall money supply will change. In qualitative, you can target a specific sector, target a specific area, and change money supply only in that area. That is the concept of qualitative set of tools. Then, can I discuss the other tools which are present under qualitative now? Second one, variation of margin requirements. What do you mean by margin? Let me give you a basic example here. Imagine you go to a bank. You want to purchase a home. You want to purchase a home. The value of the home or the flat is 1 CR. The value of the flat is 1 CR. The bank will never give you 100% of price of the flat. Right? The bank will never give you 100% of the market price of the flat or the home or the house for that matter. What banks generally do is certain percentage, again generally fixed by Reserve Bank of India. Certain percentage. There is a technical term for this, loan to value ratio. It was there in the newspaper very recently in the context of gold loans. There's a term called as loan to value ratio, LTV, loan to value ratio. Now, let's say hypothetically, the value of the house is 1 CR and let's say RBI has decided maximum 75%. What does it mean? 75 lakh will be the loan provided by the bank. What is the difference between the price of the flat and the loan that is given to you? 25 lakh rupees. Simple numbers I'm taking. I'm not taking complicated numbers or difficult numbers because I know 9 o'clock, most of you are sleepy. Some of you have already slept off. Some of you are snoring. But just ensure that you will not be disturbing other people who are also sleeping in the room. Right? So 25 lakh. This 25 lakh is called as margin. This is essentially referred to as margin. Now, simple question to all of you. Because of RBI guidelines, if the margin will go down from 25 lakh to let's say 5 lakh, think of this. If margin is reduced, the bank will give you 95 lakh rupee loan and only 5 lakh you will have to put from your pocket. Don't you think because of the change in the margin like this, more housing loans will be taken now? Yes or no? I want an answer from all of you. More housing loans will be taken because of this. And what if RBI is worried? Lot of people are taking loans. What if they do not repay? What if, right, there is a danger that recession might happen after 1 year or 2 years, etc. RBI can change the margin. Instead of 75%, the LTV can be dragged down to 60%. If LTV is 60%, in this context, bank will give only 60 lakh as a loan. You will have to put in 40 lakh from your pocket now. Not 25 lakh. You will have to invest 40 lakh rupees from your pocket. Don't you think it will prohibit, it will push away lot of borrowers from the market? Lot of people will simply say, I could have managed 25, but 40 lakh is not possible for me. It is beyond my limits. So, not now. Maybe in the future, I will take a loan, purchase the product in the. So, everybody is okay. By changing the margins, can RBI either increase the demand for these kind of loans, increase the money supply in this segment, reduce money supply? Answer is yes. Everybody is okay. Please do let me know. Everybody is okay with this kind of a tool, right? So, variation of margin requirements. Regulation of consumer credit. RBI will simply send a directive to a bank. Do not provide so much percentage beyond so much amount of money in the form of, let's say, vehicle loans. Do not provide more than 10% of your total loans for housing sector. Do not provide more than, right, let's say 15% of your total loans for this kind of a borrower. So now by changing the consumer credit, by changing the limit on consumer credit, can RBI increase or decrease money supply in a specific sector, specific industry? Everybody is able to understand the argument here? Everybody is able to understand? So different types of tools are there. Moral suasion, direct action, and publicity. Simple ones. What do you mean by publicity? RBI will publish through advertisements, through, right, let's say the ads in YouTube, ads on TV, ads in, right, newspapers, etc. RBI will publicize their policies. RBI will put their policies in the public domain. What is the logic? If you know that there is a concept of PSL where education loans have to be provided, don't you think that will help you approach a bank, borrow under education loans from the bank? If you know housing loans are being provided by, right, the banking sector, they are not allowed to charge this much rate of interest or higher than this. Will you not approach a bank, demand, right, a housing loan according to the latest policy of Reserve Bank of India? That is publicity, creating awareness amongst the customers. Publicity, right? That is called as publicity. What is moral suasion and direct action? Moral suasion essentially is a warning. It's, right, basically a warning that is given by RBI to banks. RBI says PSL has to be this much percentage. You are not following it. Right? I gave you a directive to change consumer credit. I asked you to not to provide loans, right, beyond this limit to a particular set of borrowers. Banks are not following it. RBI will send a letter, RBI will warn them, RBI will send a notice to the banks. Ask the banks to simply follow the guidelines. That is moral suasion. And if the banks do not follow, even after receiving the warning from RBI, if the banks do not follow, RBI will impose penalties on the banks. RBI simply will impose penalties on the banks. And that is essentially called as direct action. That is called as direct action. So everybody is okay? Please do let me know. I've covered the quantitative set of tools, qualitative set of tools. Right? All of these are essentially part of monetary policy tools or credit control tools. And according to the requirement, whether to promote growth or to control inflation, etc., according to the requirement, RBI will keep on using these kind of tools. Now, let me solve certain questions, practice as well as the PYQs. Then, if you have any kinds of doubts or confusion, right, raise these particular issues. I will address your issues. Then we can close the session. Now, let's say there is one more MCQ here. Please solve it. Which of the following are not to be followed if RBI aims to control inflation? I'll repeat the statement. Let's solve the questions first, then I will take up your questions. Okay. Which of the following are not to be followed if RBI aims to control inflation? Right? What kind of tools are used to control inflation? Eliminate them. Eliminate, because which are not to be followed. Opposite of what are supposed to be. Buy government securities from the market. If RBI will purchase government securities from the market, money supply will increase. If money supply increases, it will contribute to inflation. Should RBI follow this to control inflation? No. Right? So, which of the following are not to be followed? First one, you should not follow. Increase CRR. If CRR is increased, banks will have to deposit more money with RBI. Banks will keep more money with RBI. If banks will keep more money with RBI, they will have lesser amount of money to lend in the market. Money supply will go down. Right? So this can be used by RBI to reduce money supply to control inflation. Okay. So second one will be followed. Reduce repo rate. If RBI wants to control inflation, RBI has to increase the repo rate. If RBI will reduce the repo rate, it will contribute to inflation. So yes, right, RBI should not do this to control inflation. So first one and third one are not supposed to be followed. Right option for the question will be option C, 1 and 3. Okay. Next, before I take up the PYQs, a lot of you, I hope you understand this. This is my suggestion to all of you. Whenever you come across these kind of tools, I know I will give you handouts. You would also have made notes. All of these tools put together generally will basically make notes of 2 to 3 pages. My suggestion to you people is, rather than making notes for 2 to 3 pages, make a simple table. Make a simple table. For example, this table. This table you can easily use in 5 minutes to revise all the important tools under the quantitative set of tools. Is my statement clear to all of you? Quantitative set of tools. So this table you can easily use to revise the quantitative set of tools within 5 minutes. Even 5 minutes will be very long if you, right, basically read and then make a table like this. What is the meaning of the tool I've written? And right, whether the collateral is included, not applicable, not included, that information is there. Is essentially the information that you need to remember associated with the tools. Okay. Now, let's solve the PYQs. Let's solve the PYQs. First one, when the Reserve Bank of India reduces the statutory liquidity ratio by 50 basis points, a lot of you will read the term 50 basis points and stop there itself. That is, some of you will not understand what is 50 basis points. Simple. 100 basis points is equal to 1%, which means 50 basis points will be equivalent to how much? 0.5%. So the statement is, if the RBI reduces the SLR by 0.5%, which of the following is likely to happen? Which of the following is likely to happen? India's GDP growth rate increases drastically. Underline the term drastically. Do you think just by reducing SLR by 0.5%, GDP will jump? GDP will suddenly increase? No. Right? No, I hope you understand. Some of you will say, sir, it can happen. then my dear SLR has been reduced multiple times already. It doesn't jump drastically like this. Foreign institutional investors may bring more capital into our country. No connection. Scheduled commercial banks may cut their lending rates. Right? Scheduled commercial banks, that is those who have maintained SLR. Now, because the SLR has gone down, they will have more money to lend. More money to lend means what? Obviously, they may cut the lending rate. Everybody is okay with this? Do let me know. Everybody is okay? Right option is option C. What about option D? Underline the term drastically. Drastically, things will not happen, my dear. Please remember. It may drastically reduce the liquidity. First and foremost, drastically will not happen, but liquidity increases by reduction of SLR, not reduction of liquidity. Done? Right option is option C here. Okay. Next one. PYQs. Right? Second PYQ. Consider the following statements. First statement. The governor of Reserve Bank of India is appointed by the central government. The statement true? Do let me know. Yes. The governor, the deputy governors, right? How many governor is there or how many governors are there? Only one governor. One governor and up to four deputy governors. Up to four deputy governors, right? Who will appoint them? It is the central government. It is the central government, right? Statement one is correct. Second one, right? The certain provisions in the Constitution of India give the central government the right to issue directions to RBI in public interest. This statement is incorrect. Why? Listen to me carefully. In the Constitution of India, there is no power for Government of India to issue directive. In fact, under the Constitution of India, the area where RBI is mentioned is under the seventh schedule. Seventh schedule. And what is the connection of seventh schedule? What is the importance of seventh schedule? The powers, the list. What are the subjects under the central government? What are the subjects under the state government? And concurrent and residuary final. Right? The RBI is mentioned under the central government list. The power regarding RBI is with the government. That's it. But is there any provision, not in the constitution, but somewhere any provision is there? Please remember, there is one provision, section 7. There is a section 7 under RBI Act. There is section 7 under RBI Act of 1934. Using this section 7, RBI will be consulted. Government of India can issue a directive to RBI in public interest. RBI has to follow it. Right? So it is there under the RBI Act, but not under the Constitution. Second, incorrect. The Governor of Reserve Bank of India will draw the powers from RBI Act. Yes. RBI Governor is not a constitutional position. Please remember. RBI Governor is not a constitutional position. Right? The powers, the appointment, right, the tenure of RBI Governor, everything will be from RBI Act of 1930. Right? So first one is correct. Third one is correct. Right option for the question will be option C, 1 and 3 only. Next. In India, the central banks function as a lender of last resort. One function of RBI called as a lender of last resort. What is the meaning of lender of last resort? Please listen to me carefully. It simply means if a bank is facing emergency, I repeat, if the bank is facing emergency, they can always approach RBI. Is everybody able to understand my statement here? Remember this, I'll repeat it again. If the bank is facing emergency, they can always approach RBI. For what? For assistance, borrowing purposes. Sir, why RBI is called as lender of last resort? RBI is the regulator. RBI is also referred to as a lender to the banks. RBI will come into picture when a particular bank is facing emergency. That is the reason RBI is called as a lender of last resort. Everybody is okay with this statement? Please do let me know. Lending to trade and industry bodies. RBI doesn't do this. Always remember, RBI doesn't give loan to a company. RBI will always deal with banks. Banks will deal with companies. Banks will deal with, let's say, individuals. Banks will deal with other types of borrowers. RBI doesn't directly deal with, right, let's say the corporate or individual borrower. Right? First one is incorrect. Providing liquidity to the banks having temporary crisis. Yes. Lending to government to finance budgetary deficit? Absolutely no. Absolutely no. RBI will provide assistance to government. We will discuss that tomorrow. RBI will provide certain types of loans to the government of India. But that is not under the function of lender of last resort. Lender of last resort simply means bank, crisis, RBI. That's it. Right? Government doesn't come into picture here. Everybody's okay? So second one is correct. Right option is option B, 2 only. Done. Okay. So these are some of the PYQs associated with the monetary policy functions of RBI. Now, if you have any kind of questions, throw it at me. I'll address your questions. Do let me know. Any kind of doubts or questions you people have, rather than asking earlier, ask me now. Since the beginning, from the first class itself, I'm telling you, any doubts, reserve it at the end of the session. I'll take up your doubts. Tell me now. Any doubts you people have? Sir, FIIs are likely to bring more capital as SLR induce a growth rate by having money supply making investment destination. May or may not happen, my dear. There is no guarantee associated with that. What is more likely to happen? Out of all the option, what is more likely to happen? More likely is banks are likely to reduce interest. Done? Okay. Uh, Sir, CRR deposited by bank with RBI can withdraw anytime? No. Generally, RBI will not allow the banks to withdraw because it is generally taken as a safety. It is done in order to ensure that the banks do not lend more in the market. They do not end up lending, becoming very ambitious and giving all the amount of deposit. Okay. Direct action. Direct action simply means RBI through moral suasion will try to persuade the banks. They'll try to persuade the banks. That is RBI simply saying you are not following these guidelines. Please follow. It's a warning to you. You're not following it. Even after that, if the banks do not follow, RBI will impose penalties. RBI might charge a higher rate of interest when they will give loan to these banks. That is called as direct action. Operation twist, my dear, that will take half an hour. Operation twist, essentially, I'll give you in 1 minute, because if I don't answer it, Chirag will basically type and say, Sir doesn't know what is operation twist. That's the reason he did not answer my question. Under operation twist, simultaneously, that is more important. Simultaneously, RBI will sell and purchase same value of government security. I'll repeat the statement. Right? What is operation twist? RBI simultaneously, that is at the same time, same value of government securities will be bought and sold by RBI. That is called as operation. Okay. How can a weaker sections be a sector? It is not a sector, it is a type of a borrower. It is a type of a borrower. Weaker sections in different areas will be given preference. Okay. What is repurchasing order? Repurchasing order simply means today I will sell an asset to you. But when I'm selling, I will sign an agreement. Both of us will enter into an agreement saying that after, let's say, 7 days, I will repurchase. I will repurchase at a specific price. That is called as a repurchasing order. Okay. Ah, whether SDF is opposite to bank rate, rather than thinking it as opposite, right? I hope you understand. Rather than simply thinking it as opposite, right? Just remember this. Under STF, banks will deposit money, earn interest. Under bank rate, RBI will give loan and charge a rate of it. I'm hesitant to use the term opposite because you might simply use the same when you write or when you're giving an answer in the interview. Okay. Explain publicity. Publicity essentially means RBI will use different tools to create awareness amongst the banking customers. Simple. RBI will use different tools to create awareness amongst banking customers. That is, right, let's say publicity. Ah, Tirth Kumar BV. It is complicated concept. Need to watch again. My dear, don't complicate it. Keep it simple. Keep it simple. Okay. Is SDF short term or long term policy? Term, please do not associate it with STF because it is available throughout the year. You want to deposit money with RBI? Keep it. RBI will give you rate of interest. That's STF. Okay. And I received certain mails from certain number of students who are attending the session. Their question was, sir, are you having any new, right? Let's say batches. Are you starting any new batch in the, right? Let's say near term. Starting Friday, I'm launching a new batch. Those who are interested, check it. Okay. Starting Friday, I'm launching a new batch morning 6 to 9:30. 6 to 9:30 a.m. morning. What will be discussed, right? What is the structure of the course? Simple. Every day, I'll be discussing certain concept. At the end of the session, I'll be giving you 5 questions for practice purpose every day. 32 days, let's say 160 questions. So, right, 5 days for 5 questions, MCQs for practice. Those who want to write mains answer writing every Saturday, right? Let's say 1.5 hour will be dedicated for mains answer writing. And most of you worried about notes. Those who are part of my course, they will get my handouts, right? The notes regarding the current affairs as well as the static portion. Those who are interested, please do check out the details, right? The link is provided in the description. Done. That's it then. Take care, right? So that's it. In today's session, we'll stop the discussion. Do not worry about this PPT as well as, right, let's say the PDF after the session is over in my Telegram channel. Both of them will be uploaded. That's it from my side in today's session. See you tomorrow sharp again at 8 p.m. We will pick up one more very important concept, that is fiscal policy tomorrow. Okay, that's it. Take care. Have a great day.